I'm Peter White. Welcome to the Inside Network. Welcome to the Inside Network. I'm Peter White, and my guest today is Jeff Schulze, Head of Economics and Market Strategy at ClearBridge Investments. Jeff developed what's known as the ClearBridge Recession Risk Dashboard, also known as the Anatomy of Recession program. Today, the AOR platform has been engaged by over 200,000 industry professionals over the last 12 months. They're looking for insights into indicators and what's going to happen to the US economy to make their asset allocation decisions. Jeff, welcome.
Glad to be here.
Why did you develop this platform in the first place?
Well, I started the program back in 2016 when I stepped into the role of Head of Economic and Market Strategy at the firm. And a key question that investors had on their mind was, when was the next US recession going to hit? After being shell-shocked for 50% plus declines in the prior two recessions, I wanted really to design a program to educate investors on where we were in the economic cycle, and the ClearBridge Recession Risk Dashboard was born from that. But it's not just the dashboard in the program. We also give our views on other economic data that we think is important, but also where we see U.S. equities over the next 12 months. So it's been quite an evolution since its development just 7 years ago.
Well, the dashboard is flashing recession imminent, I gather. Why do you think there will be a recession in the next 6 months?
Well, it's a stoplight analogy where green is expansion, yellow is caution, and red is recession. And we've had a recessionary red signal since August of last year.
Oh.
Yes, it's been quite a while. And we felt, given the strength of the U.S. economy, that it would take about a year for the rubber to hit the road and that recession to materialize. Now, importantly, since that red signal, we still continue to believe that it will be the third quarter of this year when the downturn comes. But the dashboard has degraded quite a bit with, out of the 12 indicators, only 2 are not flashing a red signal at the moment. So we think there's clear and present danger to this expansion.
And how deep or shallow will the recession be, according to your dashboard?
Well, right now, we think that it's going to be a more moderate or longer recession. A lot of consensus thinks it's going to be short and shallow. The dashboard is in heavy red territory, but the reason why we feel that way is we think the Fed's reaction function is going to be delayed because of the high inflation that we currently see. In fact, if you go back to the 1966 soft landing, when the Fed pivoted with the unemployment rate at 3.8%, that causes a doubling of core inflation over the next couple of years and really started the structurally higher 1970s. We think the Fed recognizes what's at stake here, and they want to create more labor market slack in the U.S. economy before potentially pivoting. And if you have a delayed reaction function, that means a deeper recession, all things being equal.
So how does this impact on equity markets now and into the immediate future, your dashboard?
Well, right now, equity markets are in rally mode after a better than feared earnings season. More importantly, it's not a surprise to see equity markets rally after the last rate hike and before the first rate cut. Markets usually rally about 5%, and I think the market's got a little bit of a head start in pricing that after March's hike. But more importantly, if you look at the data, it's mixed. And it's always mixed as you head into an economic downturn, and it creates quite a bit of confusion. More of the leading data is cooling, the coincident data is mixed, and the lagging economic data that you're seeing right now is pretty high, whether we're talking about inflation or wages or the jobs number. More importantly, if you look at the leading economic indicator index, better known as the LEIs, they've declined for 12 consecutive months. And the only 2 times where you've seen more monthly consecutive declines was 1973's and 2007's recessions. Maybe looking at the LEIs from a different vantage point, the largest decline of the LEIs on a year-over-year basis prior to the start of a recession was negative 5.7% ahead of 1980's downturn. Today, we're well through that threshold at negative 7.8%. So while you have a mixed data backdrop right now, if you look forward into the windshield, it looks like that there's going to be a crash up ahead.
Well, equity performance during recessions, can you speak to that characteristic? And yet some people are thinking that now is a good time for long-term investors to get into the market.
Well, usually from peak to trough declines, the S&P 500 loses a little bit more than 30% during a recessionary sell-off. More importantly, I think that we haven't seen the lows in the markets quite yet, because if the lows have been put in, it'll be the first time in modern history where the market bottomed prior to the start of a recession. So I do think that we will retest the lows that we saw back in October. However, the fact that we hit bear market territory is usually a good sign for long-term investors to methodically put money to work as volatility ratchets higher. If you look at all the bear markets that we've seen since 1940, and you bought the day you hit negative 20% territory, the market goes down another 15.6%. But if you bought the day you hit bear market territory, yes, you had some initial pain, but looking out 12 months, you recouped all of those losses and were up an additional 11.8%. Looking out 18 months, the markets were up 18.5%. So yes, it's going to be choppy. This recession needs to be fully priced, but we advocate for investors to use weakness as an opportunity to allocate into the markets.
Well, the employment numbers in the US have been quite remarkable over the last few months or even last year, yet the Fed's trying to cut employment. It doesn't seem to be working, or is it?
Well, the Fed wants to weaken the labor market, again, because they don't want to repeat the sins of the late 1960s, where they saw inflation double because they pivoted too early. And the Fed hasn't had a lot of success in creating slack in the labor market. Yes, you've seen the number of job openings move down 2.4 million, but we're still 2.5 million above what was seen prior to the pandemic. A different way of looking at this is to look at the number of job openings to number of people that are unemployed. Today, it's down to 1.6. Prior to the pandemic, the highest you've ever seen this ratio is 1.15. So the Fed still has quite a bit of work to do. And I'm sure the Fed was pretty discouraged after hiking just last week to see the unemployment rate drop to a 53-year low at 3.4%. So not a lot of slack out there.
Well, this leads us to the next logical question of how long and when you think the Fed will pivot to lowering rates, which a lot of people are saying, and they're predicting several reductions before the end of the year. What's your view?
Well, right now, the market's pricing in about 4 cuts by January of 2024. I think that is misplaced. That is the Fed's reaction function of the past. This is not the new Fed's reaction function that really wants to create more slack in the labor market. If you look at the Fed's dot plots or their expectation for the unemployment rate, they're expecting it to rise to 4.5% at the end of 2023, which would be the equivalent of around 1.9 million job losses. In that environment, the Fed expects themselves to keep rates above 5%, so higher for longer, restrictive territory. Now, when will the Fed potentially pivot? I would say hitting 4.5% unemployment is probably one bogey to look for. The second bogey would be to see core inflation move back into the 2% range. It could be the high 2% range, but something sub 3. Maybe more importantly, how quickly is the economy deteriorating and how quickly is inflation falling? If it's falling out of bed very quickly, the Fed could pivot a little bit more quickly than I'm anticipating. But if it's this slow grind lower, I think that pivot is going to come in 2024, and it may not be a very large pivot at that.
So how many rate reductions, if any, are you factoring in or predicting before Christmas?
Well, if we have an orderly decline in economic activity, some resilience in the labor market, I'd say 0. I think that the first rate cut will come in 2024. If you do start to see things deteriorate fairly rapidly, I could see 1, maybe 2, but it's not going to be nearly enough to really change the trajectory of the economy.
What's your long-term view on inflation, given where we are today?
Well, it comes back to whether or not the Fed does what they're saying they're going to do. If they create enough labor market slack in the economy before they pivot, I think long-term inflation can go towards that 2% target. If they pivot too early, I see inflation structurally being higher at 3, maybe even 4%. But I think inflation is going to be a little bit higher than what we've witnessed in the US over the last decade for a couple of different reasons. First off, you have a very tight supply situation with natural gas and oil. That's going to be a nice tailwind to higher inflation. I think because of climate change and the fertilizer shortage, that's going to create higher food inflation. And then lastly, because of deglobalization, it's unclear whether or not companies are going to pass on higher expenses to consumers, or they're going to eat it through lower profit margins like they did with the trade wars back in 2018. But given companies' ability to pass on higher prices recently, I would suggest is probably going to be that avenue. So if you take all three of those together and the Fed does allow for higher slack in the labor market, I think we'll see longer term inflation at 2.5%. If they pivot too early, I could see it clearly being above 3.
Of course, the Anatomy of Recession platform is focused on what's going to happen in the US economy. How do you rate the state of the global economy as we sit here today?
Well, I think you really want to pick your spots, right? Although Europe has been fantastic on a relative basis and from a financial market perspective, given the fact that the ECB has embarked on one of its fastest tightening cycles in modern history, we're going to be approaching winter again, where you could see some energy issues as well. I can think that the European economy will likely see a recession at the end of this year. So I think there's a lot of optimism priced in that particular market. But I am optimistic on Chinese reopening and a lot of countries that are dependent on that growth. So I think you really want to pick your spots in the global ecosystem. And then looking at China, it's been a little bit of a uneven reopening. You saw that across most developed nations over the last couple of years. I think that ultimately continues, but the fact that policymakers continue to be accommodative at this point, I think eventually will restore consumer confidence in China and create a more robust reopening and a durable recovery.
Jeff Schulze, keeper of the Anatomy of a Recession platform or program, thank you for your time today. And if anybody wants to follow the program in Australia particularly, how do they do that?
You just go to the ClearBridge website and you'll be able to sign up there.
Terrific. Thanks for your time.
Thank you.